Greeting to all of you. Today I am going to discuss about the second part of capital budgeting. Earlier in my first video I discussed about the meaning, definition of capital budgeting, their need and importance of capital budgeting I have discussed already. Then what are the process of capital budgeting, kinds of capital budgeting also have discussed, but one more topic it is left, that is the methods or technology of capital budgeting. Under this technology there are basically two techniques for evaluating the project of a business. So today I will discuss about the techniques of capital budgeting with different method I will explain, and examples are also there. So let's see how to check. See, today I will discuss about the methods of capital budget or evaluation of investment proposal. So let me tell you one thing, that for the investment, when a business is going to invest somewhere, at that time, at each point of time, a business firm has a number of proposals regarding various projects for the evaluation. And why it is so? Because of the funds with the firm is always limited. So in that time it is possible to invest fund in it is not possible to invest fund in all the project simultaneously. So in this case what they do, it is very essential to select the best or the which gives the maximum benefit to the company. And the crux of the capital budgeting is the allocation of available resources in various proposals. There are many considerations, economy as well as non-economy, which influence the capital budgeting decisions. The crucial factors which influence the capital budgeting decision is the profitability. Risk are directly related, means the higher the profitability, the greater the risk, or vice versa it may be. So for this reason, there is two methods have been given. One is a traditional method, another one is modern method. Traditional method is also known as non-discounting method, whereas modern method is known as discounting method. Under when you go to the check to payback period, they have two method, payback period and average rate of return. But payback period, there are some limitation. With that limitation, they have one another addition in that, to whom we say improvement, that we will check. Improvement of traditional approach, these are this traditional or non-discounting method is have been improved through different four methods are also there, that I will check later. So if I talk about the non-discounting method, in that there are four methods, not four, but I have taken only four. One more or two more methods are there. Net present value, internal rate of return, modified internal rate of return, profitability index. So these are the total methods for evaluating the project of a business. So today in this video I will discuss only for the traditional or non-discounting method, and in this I will discuss about payback period and average rate of return. So let's see. First I will talk about the traditional method or non-discounted method. Under this I have given here three methods are there. Payback period, number one, and another one is improvement in traditional approach. Under this you will find four methods are there. One is post payback profitability method, post payback reciprocal method, post payback period method, discounted payback method, and the third one is rate of return method or accounting method also it is known as. But in this there are also four methods are there. Average rate of return method, return per unit of investment method, return on average investment method, and average return on average investment method. So these are the methods that I will discuss in this video. So first let me start from the payback period. What is actually payback period? Payback, sometimes also called as payout or payoff period method, represent the period in which the total investment in permanent assets pays back itself. So you can see I have one question you can understand from this. See, in this payback period it is a length of a time required to recover the initial cash outlet on the project. Let's have an example here. When there are types are there in payback period, how to calculate when inflow is unequal or when inflow is equal. So first I will talk about the when inflow is unequal. In that case, I have taken one example. If a project involves a cash outlay of rupees 60,000, this cash outlay means the investment. It is the initial investment of a business, and generate inflow means every year this amount year 1 2 3 4 5 is there, that cash inflow of rupees 10,000, 15,000, 15,000, 20,000, 30,000 respectively are getting. So in this case, how we will calculate? Another question I have, you can check here this how you will calculate this payback period. See, this is the in the first, and you can check here that first and second fourth year its payback period is 4 year, because the sum of cash inflow during 4 years is equal to the initial outlay. So let me take this marker, I'll explain it. See, you can see easily here that first year 10,000 rupees, second year 15,000 rupees, third year 15,000 rupees, and say fourth year for 20,000 rupees. You can check 10 plus 15 25, then 15 40,000, then 20. So this will be your this 4 up to 4 year your cash outlay will come out, you will get it back. So this is the technique through you can find this is the payback period. 4 year is your payback period, but sometime what happened that your cash inflow is not equal to your cash outlay. If suppose instead of 20,000 you may get like 25,000, in that case the year payback period will be 4 for 5,000 you have to calculate something like 1 2 3 or 3 3 like that will be the period. So that will be the actual period. So this is the here in this case you can find here that and how many years you are getting your cash outlay back. So in this case you can check first year 10 15 15 and 20 you are getting, in fourth year you are getting the entire 60,000 rupees. So this is fourth year is your payback period. This case is happening in the case of unequal. Now I will talk about the when inflow is equal. So in that case what you will see, I have an example. If a project involves an initial cash outlay of rupees 10,000 and generates a constantly inflow of rupees 3,000 for 4 years. So there is a one formula you can find through this, like payback period would be is equal to initial outlay of the project divided by annual cash inflows. So how much initial outlay is given, so you can check here initial outlay is given 10,000 rupees. So you will take 10,000 rupees. Annual cash inflow, how much annual cash inflow is there, 3,000 rupees. You will take this 3,000. So when you will divide, you will find the actual cash actual payback period. So here it is 3.33 years. This is your, in this case, in the case of equal, this is your payback period. In this 3.33 years you are getting back your 10,000 rupees. See, but due to some certain reason or certain advantage disadvantages, limitations, this technique is not perfect for all kind of projects, and I'll tell you what are the disadvantages of it. Due to this they have improved this traditional approach for the payback period method. So first thing that it does not take into the account of cash inflows earned after the payback period, and hence the true profitability of the project cannot be correctly assessed. Second one is that it does not take into the consideration of cost of capital, which is very important factor in making sound investment decision. Then third one, you can check it that it may be very difficult to determine the minimum acceptable payback period. Then it treat each asset individually in isolation with other asset, which is not feasible in real practices. And payback period method does not measure the true profitability of the project, so as the period considered under this method is limited to a short period only, and not the full life of the assets. You can see here that this method is very simple and oldest as well. So due to this reason, this payback period they have improved in this method, and for that reason you can check here that traditional improvement in traditional approaches. You can check, go back and check it here, improvement in traditional approaches like post payback profitability method, post payback reciprocal method, post payback period method, and discounted payback period. So I'll discuss one by one. So first let me take this post payback profitability method. For this you need to calculate the annual annual cash inflow is under this you have to find estimated life minus payback period. What happened in this on one of the why this is happened? Because of the serious limitation of payback period method. It does not take into account the cash inflows earned payback period. Hence the true profitability of the project cannot be assessed. So an improvement over this method can be made by taking into account the return receivable beyond the payback period, and these returns are called as post payback profit. So now I will show you this. Let's go. So let me tell you this second post payback reciprocal method. In this sometime what happened, the reciprocal method is employed as estimate the internal rate of return generated by the project, and this reciprocal methods through this the payback period calculated annual cash inflow divided by total investment. Just you have to reverse this this method. You can check here annual, go back and check that here I have taken that initial outlay of the project divided by annual cash inflow. It's a reverse of when you go to the reciprocal, it will reverse this entry. See, next one is post payback period method, and this is also due to the some limitation it has been introduced, and under this you can see here that it ignores the life of the project beyond the payback period, because post payback period method takes into account the period beyond the payback period method, and this method is also known as surplus life over payback method. And according to this method, the project which gives the greatest post payback period may be accepted, and the method can be employed successfully where the various projects under consideration do not differ significantly as to their size, and the expected cash inflows are even throughout the life of the project. So next one is the discounted payback period. It is also another kind of limitation, disadvantages of payback period method. And why it is so? Because it ignores the time value of money, and which is very important part to understand and to estimate the time value of money. And so that's why they have made some improvement in this method, and they employed the discounted payback period method. Under this method, the present value of all cash outflows and inflows are computed at appropriate discount. I'll show you in the question, you will understand easily. And the present values of all the inflows are cumulated, okay, and in order of time. See, the time period at which the cumulated present value of cash inflows equals the present value of cash outflows, and it is also known as discount. It is known as discounted payback period, and this project gives a shorter discount payback period. In that case, it is accepted. And let's go to the question, and we will discuss there. I have one question in that we will understand payback period, that already I have discussed, but again I have taken this here. Payback, we will find out the payback period, post payback profitability, and post back profitability index we will find over here. So see this question, that for each of the following project compute payback period, post back profitability, and post back profitability index. See, you can see here that initial outlay of the project is rupees 50,000 rupees. Then annual cash inflow after tax but before depreciation, it is given 10,000 rupees. Estimated life 8 years, it is given. B portion, there are two questions. One is your inflow is this case of your when your inflow is equal, and this is case for when inflow is your unequal. So we will find out the same thing, payback period, post back profitability, and post back profitability index in case of equal and unequal inflows. So second question is all about the initial, the same amount is given. Annual cash flow after the tax, it is given first 3 years 15,000, then next 5 years 5,000, and estimated life of 8 years it is given, and salvage it is given 8,000. Let's go to the solution. This is the solution. First this is the case of equal. So under the equal cases, first we have to find payback period. For payback period, as I have told you, that investment or cash outlay divided by annual cash inflow. So in the question it is given that investment amount or initial outlay is given 50,000. So that's why you can check here that 50,000 it is written. And in the case of equal, you can check here that 10,000 annual inflow is there after deduction, I mean after tax but before depreciation. So that's why it is taken here 10,000. So it is very easy, and the same way we have calculated that your payback period is 5 years. This is the payback period. Okay, this 5 years it is taking for getting back this investment amount. Second one is post payback profitability. Under this, as I have told you, I have given you the formula. Annual cash inflow, for annual cash inflow is given 10,000 rupees, and estimated life also given 8 years minus payback period. Payback period which we have calculated this 5 years. So how to do this? Annual cash inflow 10,000 I have taken, under the bracket estimated life I have taken 8 years, then post payback then payback period which we have calculated this 5 years I have taken, and when you will do it, the 8 minus 5 will be 3, and multiply by 10,000 it will become 30,000. So this is your post payback profitability. Now you have to calculate the index. How much index will be? It is very simple. You have to take the post payback profitability divided by investment. So here you can check for post payback profitability index is equal to post payback profitability is equal to 30,000 divided by investment is 50,000, multiply by 100, you will find the index is 60,000. So this is the case of equal inflows. Now I will talk about the when your cash inflow is not equal, in case of unequal. So you can check here. First you have to find first year cash inflow is 15,000, second year cash inflow is 15,000, third year cash inflow is 15,000. It is given as it is given in the question as well, so that the same thing here in the solution has been taken. So fourth year cash inflow, it is said that 5,000. So total when you will add up all this 15,000, 15,000, 15,000, you have to take for calculating payback period, as I have told you, up to the initial outlay. So first 3 years you are getting 45,000. So how much remaining is 5,000. So this 5,000 you are getting in the fourth year. So once you will add up all this thing, you will find that you 50,000 you have received in fourth year. So hence the payback period will be 4 years. It is very easy. This is the calculation of payback period. Now I will discuss about this post payback profitability. So you can see post payback profitability, it is, I have told, the annual cash inflow multiplied by remaining life after payback period. Remaining life will be estimated life minus payback period. So you can check here remaining life after payback period. How much life is annual cash flow? It is given. Go back in the question. It is given that 15,000 estimated life is 8 years. Okay, and you can check here estimated life is 8 years. 8 years here, and post payback period which we have calculated is 4 years. In this case 4 years. Earlier it was 5 years. So here we will subtract 8 years minus 4 years will become 4 years. So annual cash inflow. Cash inflow, first we have to check how much annual cash inflow is there. When we go back, it is given first 5 years, first 3 years 15,000, then next 5 years is 5,000. So we have to take 5 years 5,000. Annual cash inflow 5,000 multiplied by 4, it will become 20,000. So this is the post payback profitability. See, next one is post payback profitability index is equal to 20,000 multiplied by 100. The same thing we have done like that. The same way you have to do 20,000 divided by 50 means investment multiplied by 100. You will find the 40% is your post payback profitability index. Now I will discuss about this discounted payback period. As I have told you that this is due to some limitations in the payback period. They have introduced this method, and in this method all cash in outflows and inflows are computed at an appropriate discount rate, and that present value of all inflows are cumulated in order of time. And this is so let's see, you can see here that computed investment compute discounted payback period from the following. Here there are two projects are given. There are two mutually exclusive project X and Y. The details of the project are given, like cash outflow is 1 lakh in X project, in 1 lakh in Y project. And you can see here that cash inflow are given for 5 years. First year 20,000, second year 30,000 in case of X, and in case of Y 35,000, 50,000, 55,000, 65,000, 20 and 10,000 rupees given. So this is the inflow of project X and inflow of project Y. In this case what you have to do, and here you can see here that the discount rate you can use 12%. So for solving this question we have two methods. One, through the factor present value you can solve this question. Another one, there is a one formula. Through this formula also you can solve. Mathematical technique is there, but here we will use the factors table, present value table we will use, and you will solve, and you will accumulate the value, and we will solve this question. So in this question, after completing it, we have to find out which project is more preferable. So let's see in the question solution. So first I have calculation of net value project X is there. Year, first year 1 2 3 4 and 5 is there. In cash flow you can check 20,000, 30,000, 50,000, 40,000 and 30,000 as well it is given. Here in section C I have taken present value of rupees 1 at the rate of 12%. As I have told you that through the present value table you have to take this this value. So if you want to check this how to see, so when you take this I'll tell you in the last how to check this present value of 12%. So for 1 rupees here I have taken this values. You may stuck here, so let me finish this thing. Let's see how to find the value. Let me go back in this, and I'll show you. You can check here that this is table of present value and future value table. So as it is given in the question 12%. Let me 12%. You can check here this 12% is there, and for first year the value it is given for first year. This is the period column, and this is the row of percentage. Okay, so percentage it is given 12%. So first we will take for first year amount value will be for 1 rupees the value will be 0.8929. okay, for second year the value will be 0.7972, and for the third year the value will be 7.118. let me check in this, go back and check here. 0.8928, yes, it is similar to that, 0.7971. so in this way you have to find out this value, and you will write in all the years. Hereafter, once you have completed this thing, hereafter you have to, in the D section you can check here present value. How you will find out present value? You have to multiply with this B into C. Once you will multiply 20,000 multiply by 0.8928, your amount will become 17,856. In second year, that 30,000, again you have to multiply by 0.7971, the value will be 23,913. in the same way you have to compute all the values up to 5 years. Hereafter, when you go to the E section, you can check here cumulative present value. Cumulative present value means the first year your amount is 17,856, you have taken this one. In the next year you will take this one, 17,856 plus 23,913, and it will become 41,769. Hereafter, in the up to this year your outlay of 50,000 not yet come. So sorry, 1 lakh. So we will go to the third year, 35,585. You can check here that 77,356. You in the third year you will add all, first year, second and third. Up to third year this amount is 77,354. When still you have not got your outlay, then you go from the fourth year and you will find that 25,420 amount is there. Now here you can see here that your value is exceeding 1 lakh. Your outlay, cash outlay is exceeding. Here it is becoming 1,02,077,074. but roughly you can say that your discounted payback period is 4 years. But sometime it may be asked that tell me the exact value, exact years, exact payback period. So in that case what you will do, here I have written cumulative present value of cash inflows at the end of third year is rupees 77,354, and it is 1,02,774 at the end of fourth year. Hence the discounted payback period falls in the between of 3 to 4 years. In this year your payback period will fall. So see, for exact figure what to do. For exact figure you have to find out the differences. This is the formula that I have given here. Let's see. For difference value is equal to total outlay minus third year inflow cumulative. So total outlay is equal to 1 lakh rupees, it is given in the question, and your cumulative value in the third year is 77,354. so there is a differences of 22,626. then again you calculate total outlay minus fourth year. Once you have to do for third year, another time you have to do for fourth year. Why? Because your post payback period is lying in between these 2 years. So that's why you have to find out the total year minus fourth year inflow. lakh rupees, 1 lakh minus 1 lakh 2,774. You can see this is the difference. 27,774 value, this is in the minus, it is exceeding. So now their formula, discounted payback period is equal to 3 years. Already you know that this between these 2 years, so 3 year already it is there. 3 years plus you have to take the first difference value of third year divided by difference value of third year plus difference value of fourth year. You have to add up both and you can find this, the value is coming 3.89 years. So this is the exact time for discounted payback period. So this is the case of project YX. Here I have written calculation of net present value, but this is the discounted payback period actually. Second, we are going to calculate about the calculation of discounted payback period for project Y. Go to section A, year is given. Section B, cash inflow, means it is given in the question 35,050. The same way we will do it, and the same way we will find this present value of ₹1 for at the rate of 12%. You will find this value. Then you have to D section, you have to multiply B into C. You will find this value. Then the cumulative, the same way you will do, and you will find this value. Then cumulative present value of cash inflows at the end of the second year is ₹75,089, and it is ₹1,21,350 rupees at the end of third year. Hence the discounted payback period falls in between 2 and 3 years. For exact figure, the same way you will do. For difference value is equal to total outlay minus second year inflow, 1 lakh rupees minus 75,000. You will find the difference value is 24,911. In the second thing, total outlay minus third year, again you will do, and you will find that this value is exceeding the cash outlay. So 21,350, and again you have to, the third step you have to apply is discounted payback period is equal to 2 years. Why? Because your discounted payback period is lying between 2 and 3 years. So 2 years already it is completed. Now you have to find out the exact time for after 2 years. So 2 years you have to take 2 years plus this value. You have to take 24,911 divided by 24,911 plus 21,350, and you will find the exact year, exact period for discounted payback is 2.54 years. It is taking to get back your 1 lakh rupees. Okay, so note it is there. I have given. Now the question is which project you will select. So which time in under these two project, which project is taking lesser time, so that project you will select. So project Y is preferable because the discounted payback period is less than project X. In the project X it was 3.89 years, means today you are investing 1 lakh rupees and after 3.89 years you are getting back this 1 lakh rupees. But in case of project Y, you are investing today 1 lakh rupees and after 2.554 years you are getting this 1 lakh rupees, means that this project Y is giving your 1 lakh rupees earlier to project X. So that's why you have to choose this one. So now this was the discounted payback period. Now I will discuss about the rate of return or accounting method. This is the third type of non-discounted this is the third type of discounted method. This method takes into account the expected earning from the investment over the entire life of the project. See, under this method, this is the accounting concept of a profit. You can say net profit after tax and depreciation, which is used rather than cash inflows. In this method, various projects are ranked in order of the rate of earnings or rate of return. The project with the higher rate of return is selected as compared to the one with the lower rate of return. And this method can also be used to make decision as to accepting or rejecting a proposal or project. So the expected return is determined, and the project which has a higher rate of return than the minimum rate is specified by the firm called the cutoff rate, or it is accepted and on which gives a lower expected rate of return, that minimum rate is rejected. See in this we have four method. The return on investment method can be used for the several technique, like one I have told you, that average rate of return method, then return per unit of investment method, return on average investment method, and the fourth one is average return on average investment method. So first, one by one I will discuss. This time I am going to discuss about the average rate of return, how we will calculate average rate of return. See, the formula I have written is total profit after depreciation and taxes divided by net investment in the project multiplied by number of years of profit. Or you can also calculate this value rate of return through the average annual profit divided by net investment in the project multiplied by 100. But before going to this method, let me tell you about this method. Under this method, the profit after tax and depreciation is calculated, and then it is divided by the total capital outlay, as I have given you total investment in the project. And in other words, you can say that it established the relationship between the average annual profit to the total investment. So let's see, here I have one example that a project require an investment of rupees 5 lakh and has a scrap value of rupees 20,000 after 5 years. Here it is expected to yield a profit after depreciation and taxes during the 5 years amounting to rupees 40,000, 60,000, 70,000, 50,000 and 20,000 respectively. Calculate the average rate of return on the investment. See, for that, in this case, what you have to do, you have to first total the profit of 5 years. First you have to find out, because it is given both the formula you can use average annual profit. So if you are doing through this technique, average annual profit, so first you have to find the average annual profit. So average profit you have to find. For average profit you have to total the profit, and total profit it is given in the question 40, 60, 70, 50 and 20. 40, 60, 70, 50 and 20, it will become 2,40,000 rupees. Hereafter, how many numbers are here? Numbers means number of years of profit. 40,000, 1, 2, 3, 4 and 5. So you have to divide this. It is very simple, as you also know, you have done in how to calculate average profit in the case of goodwill calculation. The same way you will apply over here. So 2,40,000 divided by 5 and your average profit will come 48,000 rupees. Now next thing, that you have to find out the net investment in the project. It is given here that one project is required an investment of 5 lakh rupees, but here one more thing, it is given the scrap value after 5 years is rupees 20,000. So for finding out the net investment in the project, you have to subtract this scrap value, because this you are selling your scraps and you are getting this 20,000. So this will also exclude from the net investment. So 55 lakh minus 20,000, your actual value will be 4,80,000. Hereafter, you have to find out average return of average rate of return, average annual profit we have calculated, net investment in the project we have calculated. Then you have to multiply by 100. See, 48,000 we have calculated, 4,80,000 we have calculated, multiply by 100, it will come 10. This 10 is your rate of return. So this is the case of average rate of return. Now next we will discuss return per unit of investment method. So in this method, a small variation of average rate of return method, the total profit after tax and depreciation is divided by the total investment. That's why I have written here total profit after depreciation and taxes divided by net investment in the project multiplied by 100. The same example I have taken here also. A project requires an investment of rupees 5 lakh and has a scrap value. The same thing it is here, so no need to discuss again. So here you have to find the same way total profit, and total profit will become 2,40,000. Net investment, the same way you have to calculate as you have done earlier, the 4,80,000. Now you have to put in the formula return per unit of investment. Means here you need not to calculate your average profit. Only here it is given total profit you have to find after depreciation and taxes. Here you have calculated after depreciation and taxes, your profit is 2,40,000 divided by 4,80,000 is your net investment multiplied by 100, and the same here also you are getting 10% of your return. Okay, third one is return on average investment method. See, return on average investment method. In this method, the return on average investment is calculated using the average investment for the purpose of return on investment, which is preferred because the original investment is recovered over the life of the asset on account of depreciation charges. Let's see the example here. There is one machine and machine cost is 1 lakh rupees, has no scrap value after 5 years, and it is depreciated on straight line method, and the outstanding investment in the project is calculated as follows. You can check here, beginning of the first year 1 lakh rupees, second year 80,000, third year 60,000, 4 year 40,000, done for fifth year 20,000. The total amount is 3 lakh rupees. So for the average investment, you have to add up all 3 lakh divided by number of years. How many years are there? 1 2 3 4 5 3 1 2 3 4 5 6. This in Tamil you can say onde rende mune nali enji ari. So 6 years, RE years are there. So this 6 years is equal to 50,000. Okay, 6 you will, when you will divide this 6, so your amount will come 50,000. So or the another method is there, as I have told, I think somewhere I have not written here, but the average, for calculating average profit, you have to machine cost divided by 2 when you will do. So machine cost is 1 lakh rupees divided by 2 when you will do, so again you will get the 50,000 rupees. So this is the third method of return on investment method. Go to the next one. Sorry, the same question with the different same question, same thing we have to calculate, but the different question. The question which I have taken here is the same here. Project required investment 5 lakh rupees and scrap value is 20,000. Here in this case I have taken two questions. One question for calculating this, another question, this is the same question of your earlier example. So total profit after depreciation and taxes divided by net investment in the project and divided by 2. Only a small changes in this is 2. You have to divide it by 2, multiply by 100. So see, total profit the same way you will calculate 2,40,000. Net investment you will calculate 4,80,000. Then you divide by 2, multiply by 100. So 2,40,000 divided by 4,80,000, multiply, and again you have to divide by 2, then multiply by 100. The value will come 100%. So this is the third method. Return on investment method, that is the third method. Okay, next one is average return on average investment method. Under this method, it is most appropriate method of rate of return on investment. Under this method, see what happened. Average profit after depreciation and taxes is divided by the average amount of investment. In this case also I have taken the same example, same project. 5 lakh rupees scrap value 20,000 and 5 years profit is there, and you have to find out the total profit first. You will find total profit will be 2,40,000. Then you have to find out here average annual profit, the same way that you have done earlier. Annual profit you have to find. Here I have calculated the same way 48,000. Then you have to find net investment. Net investment in the project 5 lakh minus 20,000 will become 4,80,000. Then again you have to find out the average return on average investment. Average return on average investment, average return 48,000 divided by 4,80,000 divided by 2, and your average return on average investment will come 20%. This is the 20% is here. So I hope that your concept got clear regarding this capital budget techniques of non-discounted method, and I believe that you understood the concept how to calculate all these three payback period, and after that some limitation improvement of traditional approach, and the third one is annual rate of return and accounting method also, and through this you can calculate the rate of return and you can evaluate the proposal of the business. Next video I will discuss about the next part of the same next part of this method of evaluation of proposal of a business, and under this I will let you know the concept of net present value, profitability index, internal rate of return. Through all this technique I will solve your question, and hereafter your topic will be over. So thank you so much for watching my video.